Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is our 91st VideoCast and 81st podcast for the week ending July 16th, 2021. Happy Friday. Wishing everyone a great weekend, but let's get down to business here. We're going to start with the media. It was a very busy week. On Friday, we did the podcast Thursday last week, so on Friday, I was on the Clayman Countdown with Liz Clayman. I want to thank Jackie D'Ambrosi Scales and Liz for having me on Friday. Ellie was out in Sun City for the Allen & Company conference, so she invites me on, but invited me on Monday. We'll talk about that. But this was the Biden administration released about 72 actions, a bunch of executive orders on Friday, and most of them don't have real forward momentum to get done. The ones that can do meaningful things have to get through Congress. But the theme, I think, is worth looking at. First off, it was predicated on the fact that they said that over 75% of U.S. industries, a smaller number of large companies now control more of the business than they did 20 years ago. And on that basis, it was kind of interesting because if they are going to go after bigger players across industries, the sector which would benefit the most would be small caps, which we're going to talk a little bit about in our article of the week, that they've been kind of doing nothing since February. They've effectively been flat. So that could be the next catalyst in those groups. But as we drill down into the specific areas of executive orders, healthcare wants to lower drug costs by importing drugs from Canada. The Canadians don't want it, and the drug companies don't want it. So that's going to be a non-starter. But if the theme, or done in such a small amount that it won't make a difference, the theme, though, is that they want lower drug prices, obviously greater demand for the boomers, etc., and cost to Medicare. So one of the groups that's been left for dead are the generic drug manufacturers. We talked about Teva, Viatris, and these are longer-term plays. You really have to look out 3 years to get any color on to get any big multiple returns, but both of them, Viatris and Teva, and also Perrigo's in that group if you wanted a basket, they're trading at less than 4 times forward earnings. And they're doing that because in the case of Teva, they have litigation risk. As a matter of fact, one of our Ask Me Anything questions this week is about that. Let's see. Water Traveler on YouTube said, been watching Teva for a while and agree with your call. However, big lawsuits can sometimes act as an ankle weight holding price down. Maybe in the future podcast you could add some color to their ever ongoing lawsuit. Thanks for what you do and congrats on some prior calls like Wells Fargo, Pfizer, etc. So, Teva is down, some 90% from its high. And the reason you buy stocks like this in a basket is because there's no way of predicting how the lawsuit turns out on the one hand. But on the other hand, a lot of the risk is priced in it, and when it overshoots to the downside, so the peak for this stock was $68, it's now trading at $8.50. And they have some specialized drugs in addition to the generics. They have a migraine drug, etc. So this is just one of those risk rewards that you manage your risk by sizing. You diversify your risk by a basket. But I like the theme of the Perrigos. The Takedas started to move this week. The Viatris, which is the old Mylan, if you recall, they got in trouble for overpricing the EpiPens. So they're working through these legacy issues, but these are huge companies. Teva's been in business over 100 years. They'll work through, they'll pay their fines, they'll pay their penance. We just don't know. It's not a question of how it will get resolved because it'll be a big one-time event and then the market will look through at the forward earnings power. We just can't time it, and that's the key factor. But this is certainly priced in a lot. This has been going on since 2016. Basically, the stock's been rolling over, building a long-term base. But I think that's interesting because I think they're going to really pound the drum on this theme. And as market participants start to look through these left for dead, forgotten men and women, so to speak, are going to start to become more in demand. As far as transportation, he's saying that there's inadequate competition among the airlines. If there's going to be incentives for new carriers, which, by the way, seems crazy to do so quickly coming out of the pandemic, but let's just say that that's in the cards. The big beneficiaries will be Boeing and will be General Electric, the two undervalued industrial companies we like long term. And then finally was big tech. What would happen? So they want to scrutinize future and past acquisitions, what they call killer acquisitions, like Facebook buying Instagram to curb the competition, and also WhatsApp. And then if these companies were required to break up, which again is very low probability, but if you've got Google spinning out YouTube and Waymo, if you have Amazon spinning out AWS, and if you have Facebook spinning out Instagram and WhatsApp, the unintended consequences is basically that shareholders are just going to make a lot more money because the sum of the parts is greater than the whole. So that was the basis of that short segment. And then, so thanks again to Jackie and Liz. Then later that day, I was on TD Ameritrade Network with Nicole Petalides. Thanks to Declan Murphy for having me on. And this segment was about dividends. And this has become more and more popular and in focus with the 10-year yield well below 150 basis points, kind of in this 125 to 150 range, down from a 150 to 175 range earlier in the year. I think we're at 130 basis points today. And what I focused on for this segment was the dividend aristocrats. There are 65 countries in the S&P 500 which have increased their dividends for the last 25 years consecutively. So not just paying a dividend every year, but increasing every year. And the example I laid out, which I think illustrates the story better than any other, was that Warren Buffett bought about 400 million shares of Coca-Cola from 1988 to 1994. And no, it's not like he bought it in 1908 or 1918 when the company started. Number one, he wasn't alive. But number two, people will say, well, I missed it. And the answer is no, you didn't miss it. The company was 80 years old plus when he started buying these shares. And split adjusted, his basis was $3.25 a share. I don't know what he paid for. It could have well been $30 or $40. I haven't counted up all the splits. But split adjusted is $3.25 a share. And his dividend yield when he purchased the stock, I'm sure, was in the low to mid-single digits, probably 3-4%, because rates were a little higher. Right now, the dividend yield is 3.1%. However, what happens, and why these dividend aristocrats are so important, it's not just the dividend you get today, it's the dividend that you're going to have down the road as they increase, and that compounds just like the stock compounds. So his yield on cost today is 51.6% on his basis from 1988 to 1994. So every year he gets a 51.6% dividend yield, and that grows every year, by the way. In another handful of years or more, it'll be potentially as high as 100% dividend yield. And that's important to keep in mind. So Warren Buffett's received $21.45 of dividends on that 325 basis, or 6.6 times what he paid just in dividends. Plus the stock was, at the time of this segment, was trading at $54. It's moved up a little since, or 16.61 times his basis. So if you add the dividends and the capital appreciation, it's 23.2 times over 27 years, so 23x over 27 years. And this is a slow, steady consumer goods product, effectively. Now, granted, they had some international expansion in the 90s, etc. But there are plenty of interesting opportunities out there, and particularly what we had been pounding the table on was, first off, in February and the first week of March. You can refer back to our notes when we were pounding the table on utilities, staples, and big pharma. And then lately, in the last 3 weeks, because they took that initial move up, and then they were resting for 6 weeks, and now they've actually started to move up again. So there was a second bite at the apple to get involved. And I went through that group and I said, basically that's what Warren Buffett did, but there's a lot of opportunities here with low yields. The demand for those dividend yields is going to go up in the short term, and seasonally, this period of the year that tends to be volatile for the general indices in summer into early fall is when defensives, utilities, staples, and big pharma outperform. And that's over 20 plus years of data, and it probably goes back further than that. So we went through a whole table, which we'll cover in the article of the week. But the most important thing that you want to understand is it's not just the dividend that you're getting today, it's over time. And there is an opportunity because these things had taken a break in the last handful of weeks. And for those of you who've been following us know that you would have been right on top of that. So thanks to Declan and to Nicole. On Monday morning, I was on Cheddar with Brad Smith. Thanks to Allie Thompson for having me on. And we covered the executive orders as it relates to tech. He also wanted to go into a little bit about earnings outlook. And the key point that I made is, 2022 earnings, first off, earnings were expected to beat by 63% year on year. And I said, that's the good news. And the better news, it'll probably beat by 70%, which, I think a lot of people were skeptical about, but we're going to see later in the call that that's already proving to be very close to accurate. So while we're not going to grow 70% because we were shut down this time last year, the comps are easy, we will continue to grow well above trend. So when you hear this noise about peak growth, peak growth, peak growth, you had the same noise right in 2009 after the great financial crisis, and you had the same noise in 2003, and we'll get into that in the Bank of America Global Fund Manager Survey. Those are the beginning of business cycle. Remember, we're just over a year into the new business cycle. So if you look back, certainly 2010, we had 10 and 15% pullback. Same thing in 2011 to scare everyone out. But, we had the yield curve inversion. We had the recession, 2 quarters of negative GDP growth. We had the steepening of the yield curve. This is a new business cycle, and while we're in the period where there's a digestion of a lot of gains and stimulus, and you have to be more astute in finding the sectoral rallies under the surface, which we've been trying to help you along with over the last, how long have we been doing this now? 2 years. That's really where the opportunity is going to be. And the other thing we talked about is, with the market up 95% off the pandemic lows or whatever it is harder and harder to find value. We covered a bit on the mortgage originators, and, this is an interesting basket because the reason that they're down, and the basket we're looking at is United Wholesale Mortgage Corp., which is trading at 9.3 times next year's. Loan Depot's trading at 4.8 times, and Rocket's trading at 11.8 times. And the reason they're so beaten down is because the comps, the 2020 refinancings were record highs, originations were record highs, and if you look at the Freddie and Fannie data projections, they basically have refinancings going to zero because they think rates are going to go straight up, and they have originations cooling a bit. I think both are going to prove to be too pessimistic. I think that, and we covered that last week, with the biggest part of the demographic in the United States, 72 million millennials being average 30 years old, and supply coming on with lumber crashing last month, enabling builders to ramp up their plans and I think start to build the smaller starter type homes to make it more affordable. I'm sure the administration will be pushing that, as well as lowering lending standards in order to make them more widely available with lower costs. These originators specialize in qualified mortgages that they sell to the GSEs, Fannie, government-sponsored entities, Fannie and Freddie. And I think that we saw this week, as a matter of fact, I'm going to bring up an article. Maybe I can bring it up right now. Well, basically, refinancing spiked this week because rates were down, and that's the name of the game. And I think that rates are certainly going to go up steadily over time. but it's going to be less quickly than most people think. And the other thing is that many people were unemployed last year, so it's very difficult to refinance when you're unemployed. So I think that you're going to see refinancings much better than anticipating. Rates not go up as abruptly as the modeling shows, and originations in particular are vastly underestimated. I think they're going to continue as supply comes on, and maybe supply at smaller square footage, which is the name of the game. We talked last week about the amount of homes around 1,500 square feet or less. It just collapsed since the 70s, and they were accelerating like crazy when the boomers needed them. So they were huge. Think the Levittowns of the world in the 50s, boom, and then for their children, the greatest generation, and then for their children, the boomers in the early 80s. And in both cases, the 1948 to 1966 was a huge economic boom driven by housing demand, housing formation, demography, etc. Same thing with 1982 to 2000 with their kids. And we just need to get that supply of starter homes. It's not necessarily the affordability. It's just that a person buying a starter home doesn't need 9,000 square feet with a tennis court. Or 4,000 square feet for that matter, or maybe not even 2,500 square feet. So many can start with those smaller homes and then build equity and move up from there, like previous generations have done. And that's what's going to make it affordable, not trying to affect government policy to make a 2,500 square foot house cost what a 1,500 square foot house should. I think the supply just needs to change, and the market will do that for us. Okay, and then and that was basically the name of the game with Brad. Also covering some expectations on bank earnings, which we'll go into later that day. I was on the Claimant Countdown with Lauren Simonetti, thanks to Ellie Terrett, was back from the Allen & Co. conference for having me on. And in this one, we talked about bank earnings and how to look moving forward. And I think as far as general S&P earnings and general outlook, at $213 for 2022, I think what we're going to find in the next couple of weeks, and we're starting to see it already in this first week of earnings, is that number is still too low, despite the fact that it's gone up every week, basically since the beginning of the year, more or less. I think we're going to find that guidance is going to take that up closer, call it 225, 230, and then the market looks a little more reasonably valued. But there's a digestion period that comes. Earnings have been good. The market's been a little bit sideways this and particularly under the surface, and we'll talk more about that. A lot of the good news is baked in. The key is guidance moving forward. But watch those estimate numbers. They ticked up a little bit this week. We'll talk about that at the end of the call. And then we just talked about what to expect with the big banks. Trading revenue was going to be down. The loan growth, that's going to come back the second half. You've had a tremendous amount of stimulus. As that gets used up, people will start borrowing more, and banks will start to see more income on that front. Same with commercial loans as people come back to work and they go into expansion. So that's kind of a second half story. The reserve releases worked out as expected, maybe even a little better than we expected. And then we talked about Citibank as being the trade. KBW Bank Index was down about 8% into earnings. Citi was down, south of 13%, trading at 0.9 times tangible book value with a 3% dividend yield, 8.6 times next year's earning, and a huge turnaround story with Jane Fraser. She streamlined operations, and her efficiency rate's gone down by 10%, which is really good. She's taking a lot of costs out of the business. Also, their deposit growth has been phenomenal. So what we had anticipated with Citi has come to pass. Whether it's time to load the boat here. I mean, if I had no bank exposure, would I start to nibble at Citi at this level? Yeah, I'd probably put on a third of the position so I could hopefully buy a little bit lower. And if it got away from me, maybe add another third and just let it run. But we have enough bank exposure, so we're happy with that. Again, thanks to Ellie and Lauren. And then Wednesday, I think I was on CGTN talking about the global chip shortage. And the basic takeaway with that is that it's kind of at its acute phase. It was a combination of work from home, school from home, people switched to cars from mass transit to social distance, construction boom, Deere and Caterpillar needed it for their equipment, 5G rollout, and a crypto mining craze all at the same time. So cars are less than 9% of the semiconductor industry. And my basis was that, all these governments are investing, but most importantly, the companies are investing. And while there's kind of a consensus that it'll take 18 to 24 months, the actions that are being taken now are setting things up a couple years, 2-3 years down the road. The shortage of today becomes the glut of tomorrow. And we're certainly going to see that with all the plants coming on. There's 10 fabs coming on for 300 millimeter chips, 14 in 2021, 14 in 2022. A lot of investment from the government. Intel's doing a $20 billion factory in Arizona. Taiwan Semi's doing a $10 billion in Arizona. So that's not going to be a factor. And we are seeing prices now stabilize off of extreme levels. We're just not yet seeing the stocks go up. But Taiwan Semiconductor came out after this segment and said that expects the auto chip shortage to abate this quarter, which no one was looking for. So that's positive news to see. So again, thank you to Camellia Kiloan and Roe Ruttenberg for having me on CGTN America. And then finally, I want to thank Devik Jain and Sriyashi Sinyal. They had me on in their article on Monday. And what I was saying is great earnings results are already baked into the market. The name of the game is guidance. We need to see what managements have to say about their outlook to support current valuations and beyond, which is another way of saying, yeah, we're a little bit fully valued here. We need to see estimates go up to start to support a leg higher. Otherwise, we're playing the sectoral rotations under the surface, which has kind of been our base case after we got the mid-teens gain we were looking for the year, within the first 5 months. So there may be a few more percent, but I think it's going to be kind of a sideways grind, and the opportunity is going to be under the surface. And then yesterday, Herb Lash and Mark Jones over at Reuters, thanks for having me on. Okay, so what I said was staples have pricing power that could help Procter & Gamble, Coca-Cola, and others rise once it's clear their margins remain intact, said Tom Hayes. Guidance is the name of the game. A lot of good news baked in with strong guidance, and even with strong guidance, we may get a breather here. So if you remember, input costs went up aggressively last quarter for all of the consumer products companies, and I said, okay, yeah, but they're not going to give up their margins. They have pricing power and brand moats. You're going to see next quarters prices go up, and they'll retain their margins, and these stocks will be back up. And we're going to see those earnings in coming weeks, but that's really the name of the game. But the groups are starting to anticipate that. So we're going to look at a number of charts here. This was just the Citigroup profit soars as consumers rebound. They beat analyst expectations. Their checking account deposits are picking up very rapidly, which is good to see. And then Wells Fargo was the only one among the four largest to post an increase in revenue last quarter. So the market seemed to treat Wells better than the other big banks like JPM and Bank of America. They were a little disappointed in Bank of America. So that's good to see. The CFO was on with Wilfred Frost saying that, kind of alluding to the fact that the asset cap removal is going to be a longer process. So again, I'm not doing cartwheels to add to banks here. We've pounded the table for the last 6 some odd weeks that cyclicals were going to take a rest. Tech would boom. That's happened. Now tech has moved a lot. Do cyclicals get bid right away? Very, very selectively, like we started to talk about how we would think about Citi. I think defensives are going to have their day in the sun for the next few months before the cyclical trade comes back in earnest for the end of the year. So that's been our base case. That seems to be playing out. Let's take a look at some of these Ask Me Anything questions, because those have actually been the source of some of the best content in recent calls. Ben, first name only. Tom, I know you think the markets will hold up until Jay Powell is reappointed in February 2022, but how can we rule out the market makers pulling their bids much sooner? Okay. And what's your latest thoughts on if the bank's correction is over or not, and your thoughts on XLE, XOP, which are the energy ETFs? So, will institutions raise cash in this environment? We'll see. The most important thing here is liquidity. So here's what you need to know about the market. Okay? This thing, the Federal Reserve balance sheet continues to make new highs basically every single week. And until this liquidity, even if they announce tapering next week, this is still going to continue to go up in the short term due to the reinvestment process. So it's very tough to fight the Fed here, and that's not to say you can't get your 3 or 5% pullbacks. We've had 3 of them that we were anticipating a handful this year, and I think that's how this market wants to behave. Now, could anything happen? Yeah. I mean, Herb Lash, when he called me from Reuters, we were talking about the 10-year yield, like how abruptly went down so far, and I talked about, well, number one, tax returns were filed later this year, so they received a lot of cash. There's less supply because they've had to do less issuance. The Japanese have been net buyers in the last few months. That's new. And then, like, what could it, when you see yields compress that quickly, sometimes it presages like a really bad event. The last time we saw that was before the pandemic. Does it always? Absolutely not. The other thing that you need to keep in mind is seasonally over the last 20 years, yields do compress over the summer. It happens basically every single year. So this is in line with normalcy. But like, if it was presaging an outlier event, what would that be? And the only thing I could think about, because everyone's looking at, obviously, the first thing out of everyone's mouth is the Delta variant, which we'll discuss. I don't think that's it because everyone's focused on it. I think if there were going to be a crazy type of event, either it would be the Iran deal because people aren't really paying attention to it right now. But more than that, the big one would be China doing something aggressively with Taiwan, where we would have to step in, and that would be a really bad thing. But I think if there was knowledge of that, you'd see the 10-year at 1% right now, not 130 basis points. So I'm not really worried about that. I'm willing to accept that it's more of a cyclical thing. But could any of those black swan happen? Yes. If you invest on the basis of guesses about that kind of stuff, it's just a matter of time until you're out of the business. I mean, that you can't play that game, because even if you think about Brexit, it's a short-term event. You get the news, people are shocked, they puke, people on margin get called, and then people say, okay, so this is happening now. How many cans of soda is Pepsi gonna sell next year? How many tubes of toothpaste is Colgate-Palmolive going to sell next year? And it really has nothing to do with whether China's in Taiwan or not. And I think that's like lower than a 5% probability. But if you had to, look at the abrupt compression of yields, those are some outlier events. Our base case is that we grind sideways to slightly higher into end of the year with a few minor pullbacks to scare people. Certainly some big sector corrections under the surface, like we've been seeing these rotating things. As far as energy, that's a good question. It's coming a lot in anticipation with, again, if you go back the last 4 to 6 weeks, what did we say? Banks and energy would take a breather here to punish the late money, and they're scaring the hell out of the late money, and they all panicked in, and they're all panicking out. I don't know if enough pain has been done yet. I mean, let's take a look at some of these big large cap energy companies. I guess some of them start to get interesting, but, these are, this is what? This is a weekly view. So if you look on the daily, it's like, oh, they're all crashing. Oh, it's out of control. But if you step back a little bit, would I be starting to add, if I had zero exposure, I'd have to be very selective, very high quality. I would want to see a little more pain. I'd really be waiting for an Iran deal and get a dump and then, load the boat and wait for that. You may not get the abrupt thing that I'm expecting. So we're kind of neutral. I don't think I think to make it work, to cause the most pain to the most people, since everyone joined and got excited up at these levels, up here, everyone was getting euphoric. All the people that hated him last year in October loved him up here in the first quarter, hated him here, loved him here, hated, loved. I think you gotta cause a little more pain to them. I think you gotta get them to puke like below these levels, take out some of their quote technical trend lines and just knock it below that, and then take off without them. That's usually what happens. So I wouldn't, if you own it from down here when we were pounding the table before the election, I don't, there's no real reason to sell. If you were going to lighten up, you should have done so 4 or 6 weeks ago when we were talking about take off 20, 30% of your position. But over the next 3 to 5 years, these things are going to work. So the answer to your question, Ben, is neutral. The answer to the market, the answer to both of your questions, nothing has changed. I don't change based on how the market moves for a few days. So the answer for energy and has been it was going to be soft over the summer, and then the cyclical trade would re-emerge towards year end and make new highs. No change there. Markets will hold up till the end of the year. Yeah, but again, you could get these black swan events, and but they're limited in time. You just have to acknowledge there's huge liquidity in the system. We're only 1 year into a new business cycle. We got 15% corrections in 2010 and 2011. It was still the beginning. If you sold towards that at those points, you lost tens of millions. You lost a lot of money. So yeah, no change. Mikkel, Bobkoff, hi Tom, enjoyed hearing your take last week on Alibaba and the Chinese situation. Great, we're going to cover more on that. This month's inflation data has spooked many investors and made many headlines. However, the data shows that the increase in inflation comes primarily from a few categories, which represent only around 12% of the index. Energy, used cars and trucks. By the way, that's 60% of the print was the used cars and trucks, which is partially attributable to the semiconductor shortage, which Taiwan Semi just told you is going to get solved this quarter. So, and airline fares have increased 25, 45 year on year, respectively, while remaining categories have only increased modestly, about 2.5%, such as food and shelter, which make up around 50% of the index. My question is, looking at the data, is overall inflation less worrisome than is portrayed in the news, which in effect gives Powell enough room to let the economy run hot and delay tapering until 2022? Great question, and yes, that's what we've covered. I do think inflation will run above trend, but that's the goal. So long-term trend is 2. Could it run at 3 for the next couple of years? Sure, it could run at 3 or close to 3. But he told you what he's going to do this week. Feds, here we go. Powell, progress toward full employment. 2% inflation is still a ways off, hinting Fed may not be on the verge of cutting bond buying stimulus. He acknowledged that inflation in the short term ran hotter. So did Treasury Secretary Yellen, but they're still holding to the transitory story. And the reason they're doing that is because you got 9.3 million people still not working compared to 5.7 before the pandemic. So employment is number one thing. And again, nothing's changed week to week. I've been saying the same thing. But Mikkel did a great job of breaking that down, and the big fat number is the used cars. That's semis, and Taiwan Semi said that's going to be done. We covered the Teva thing. That's just, you got to just have a long view, and you got to have a basket. I like the generic theme. They're left for dead, so I would have Teva, I'd have Viatris, I would have Perrigo and Takeda, maybe 4. And, you look out, one's not going to work, but the basket's going to be up 3.5, maybe 4x, out 3 years. So we kind of like those. From Shannon, Magic Mountain doesn't have rides that are this fun. One thing I appreciate about the tools you use to produce your podcast is that they're largely accessible and or free to us little guys. I try to do that, and one thing I'm having trouble with, however, is finding a place to access various data, at least in an easily digestible format that doesn't require me to employ a research team or write a variety of Python scripts. Specifically, we continue to hear about Archegos-type blowups and unwinding of short treasury bets, etc. Curious if there exists a way to measure or estimate the cumulative level of margin in the market, the percent of shares instruments controlled by notionally by derivatives, the market share of ownership over time, the change in percent of shares owned by institutional versus retail over time. Even if these specific examples don't exist, wondering if you could share some of the less known sources of interesting data. As always, thanks for the sage advice. So this is a great question, Shannon, because I think, and I went down this rabbit hole when I was new. Everyone thinks there's some special edge, and the special edge is hard work. The special edge is experience. And there was a quote we put out by Jesse Livermore this week on Twitter that said, only the game can teach you the game. And there's nothing more important than that. 90% of the things you just asked, you can probably get through Google. Obviously, if you have a Bloomberg terminal, which I've had, you can get more of this stuff. But all these, what does that have to do with, how many Band-Aids Johnson & Johnson is going to sell over the next 36 months? Or how many diapers Kimberly-Clark is going to sell? Or all of these factors. And what happens is, there's an old quote, focus on the few things that make 80% of the difference. And what makes the difference is we look for things that are cheap. We try to understand why they're cheap. So what's the bearish thesis? Why are people so pessimistic on this? And then is there an inflection that we can, a plausible thesis that we can create with a large enough margin of safety that the thing could inflect over 1 to 3 years and be a multi-bagger. And if all those factors are in place and we've accepted a worst-case downside scenario, and we usually manage that by doing a basket of the theme, then we put capital to work. And that's it. There's no secret fix. There's no technical indicator. There's no, if institutionals or retail. The people that are most interested to see if retail people are in trades are retail people because they think everyone else is dumber than them, but they're also retail. So, I think the key is time, humility, and by the way, you're listening to this, so you're obviously, and now I'm not speaking to Shannon, I'm speaking largely. If you're listening to this, you are taking those efforts to learn the game, and you're maybe speeding it up a lot because you're getting, quite a long track record of experience to shorten your learning curve, which is helpful. But, with all this, you can Google it or you can pay for it. That's really what it comes out to. But I wouldn't focus on this. I think one of your most valuable resources is go to your public library and get Value Line and start to read 5 companies a day for the next, year, and you'll know 1,500 companies a bit. Read them every single day, and then at the end of 2 years, you'll have read them twice. They cover about 2,000 larger companies, and these are the things that Warren Buffett and Charlie Munger did and started their career, and they still do to today. You see pictures of Buffett with the Value Line binder behind him in his office. So, you don't get paid for complexity. You get paid for, if you had to put it simply, buying quality when it's on sale. Not just buying because it's cheap, because that's the misnomer of value investing, is you just buy anything that's cheap and, liquidation value and all that. No, it's cheap relative. Every sector has different metrics that make them cheap. So you could buy a company at 40 times forward earnings that's cheap. That's a value stock because it's, last 5-year range is, 35 times to 100 times, and growth is actually accelerated. So it's trading at the bottom of its multiple range. Growth is accelerating, so that multiple should actually go up, and rates are low. So you have to think about it in terms of context, and then you have to do the work. And the other thing that Buffett does, which again is the hard work, when we find a cheap company, we try to figure out what is the bear thesis, why is this so low, and then you start with the basics. You read the earnings call transcripts or listen to the earnings call transcripts in the background. You read the annual report, and then over time you start to understand the cycles, how these things cycle through, and what it looks and feels like when you're at that acute phase of pessimism, when there's just no more sellers left, is fundamentally what it comes down to. And then on the upside, when there's literally no more buyers left, it's, and you saw a little feel for that in the AMCs of the world this week. So that's my best advice, is do the work, focus on the simple things, the few things that make 80% of the difference. And what are those few things? Finding quality businesses that are on sale, that have some plausible thesis for an imminent inflection, and do the work, and you'll do far better than people saying, well, there's so many derivatives in the system, we're all going to blow up, let me get my canned food. I mean, you know how many people lost fortunes over the last 10 years with that mindset? It's like, you can never make that back. And you listen to this nonsense, you know, so that's that. We just try to keep things rational. Yeah, is the general market potentially fully valued? Yes. Is there a lot of are there some bargains still available under the surface? You bet. And that's what we try to do each week and be helpful with. Again, click on terms at Hedge Fund Tips. This is not advice. This is just our opinion. We try to share some of the things that we're doing, and then you can consult with your advisor to see if it makes sense for you. Okay, so great questions on the on that. Want to go through some of the other sectors because we've covered a lot of these over the last weeks. So yeah, I think there could be, you know, potentially some more pain and energy before like it just becomes, yeah, you should definitely start adding. The banks, on the other hand, same type of story. They've done exactly what we anticipated for the last 6 weeks. I mean, Wells had a green candle here this week. I mean, because it did better than the rest. Have these come in? I mean, the companies like Citi, 0.9 times tangible, 8.5 times forward, 3% dividend yield. I mean, if you bought it here and it went to 60, I mean, is it the end of the world? I mean, if you look 3 to 5 years out, this is probably a $90 to $110 stock in our view. So you're not going to get it perfect. These have had monster runs since October, so I think they've got to just digest this for a while. I wouldn't be in such a rush. If you missed it, you missed it. Let's get on the next horse that's going. And what's the next horse that we've been talking about pounding the table is utilities, staples, and pharma. And we talked about that first leg from late February when we put out the article. It rallied like crazy, and then it rested for 6 weeks, and now it's getting the second leg that we've been anticipating. So here's the weekly look. So remember, rally, sideways, this, and now we're getting the second leg. Now we're getting the second leg in all these names, and this was the big week that they all started to turn. And, you know, like waiting through this was just like, watching paint dry. But, you know, you just know it over time and your patience, and it does. AEP, you can't see this, darn it. Let me see if I can make it bigger. Here we go. So look at this. This is it. This is when we put the article out. Rally, consolidate, and now we're getting that second leg. And I think these things have juice. So that's what I'd be focused on. Instead of looking at the rearview mirror, if you missed banks or you missed energy, what's next? And these have not recovered, and they're all starting to go. But like, you know, you can see it clearly on the weekly. On the daily, it looks like you already missed it. I mean, look at these moves. These are just phenomenal. And it's just so exciting to see that the patience is rewarded, because it was a long 6 weeks saying, you know, these are going to take a second leg higher, and we're going to see that. So that was on the utilities. Now let's see what else we got. Okay, same thing on the staples. Look at Clorox. This thing's up 16 points in the last week or so, 10%. Kimberly-Clark, this thing was left for dead in June after they reported earnings. It's up 10 points already in the last few weeks. Colgate, how many tubes of toothpaste? I'll make this bigger so you can see it. Here, you know, rally off those February, March, huge thing, consolidate, next leg higher. So this is happening, and this is exciting. So this is what we went. Kellogg, same exact thing. Rally, and now it's taking that leg. Campbell's will eventually come around once they change their name to Campbell Snacks instead of Campbell Soups, but they'll figure that out. That's going to be fine. It even got a bounce this week. Okay, so here we go. It'll fill this gap, and then everyone will be all about soup again. You just have to be patient with these things, and so it's definitely exciting to see. I'll show you the weekly view again. These things are just getting started. Clorox, no one's going to buy bleach again. You bet they're going to buy bleach again. Kimberly-Clark, even Campbell. We'll see. This thing did a round trip on us, but this is going to be at new highs within months in our view, or 52-week highs. Colgate-Palmolive, these things are all starting to move. So that's exciting to see. And then, what was the third part? Pharma. Okay, so even Pfizer is starting to move. J&J, same type of story. Where is Novartis? So it's consolidated. It's trying to get going here. They're gonna move. So this gives you the weekly view again. Consolidate. They'll start to move. Amgen started to do it. But yeah, Pfizer's building this handle out here for you cup and handle maniacs that love those cup and handles. God bless. I think this is going to be a cup and handle. Your textbook thing, you can use it in your next books. So we love that. And, this is just defensives. It's that time of the year. The environment is set up. People are underexposed, and they'll chase them after they're up. This is the bullish percent energy thing. This is just those stocks on a point and figure buy signal. I don't even use point and figure, but this is you can see when things are at extremes or at the top. This is mid-level, but it has bottomed here, but I think you could see a little more pain in the energy before it goes. I want to cover BABA. Chinese tech stocks jump after Tencent deal gets approval. So after all the cute noise about China, and there was more today, they rated Didi and it was down 7%. Now I think it closed down 2%. We're not even closed yet. I'm doing this in the afternoon. But so this was when we did the podcast on this day, and I'll show you a clip from the podcast, the VideoCast from this week when Alibaba went below 200, and we added aggressively, took our basis to, I think, 209 and change from it was 211. So we added pretty aggressively that day. The group has turned around. Look, it's still not without risk, but here's where it was, okay? This is when we did the podcast, and we walked through this sentiment thing, okay? And it was literally word for word, and we said, we think we're in a version here, and we should get some bottoming, and maybe we'll start to recover, and then we'll get back up to here. It'll start to consolidate at denial, which is about 260, and then hopefully new highs. Now, let me show you. Keep this mental picture in mind right here. This is where we were. This flush out, what we called sweep the leg, if you remember from our Cobra Kai article with Wells Fargo last October when it was at $22. We said, this is the flush, all in, let's go. And then it just doubled. So I think this was the flush. We'll see. So far, so good. Here was the flush down to 199. When we did the podcast, it got up to 216 over the last few days, and now it's back to 212. Let me see where it's closing. So it's closing at 211.80. So we're up, 11 points in a week. Look, it's moving in the right direction. Could we get another sweep to really kill people? Yeah, but how much worse can the news get? I mean, it's the acute phase when they raid Didi. Then Didi will still be doing ride hailing on Monday. Will they be doing it with new downloads? No, but they already had, I think, something ridiculous number. I think 900 million people had already downloaded. So saying like the last 10% of people can't get the Didi app is not huge punishment. And then the question of the U.S. delistings that people are worried about. Here are the facts. The facts are there are 248 Chinese companies listed on U.S. exchanges with a combined market value of $2 trillion. So, if they start delisting, BABA is going to be the last one that they delist. But why the hell would you risk destroying $2 trillion of capital formation and put yourself at a global competitive disadvantage by extinguishing access to the deepest, most robust capital markets in the world in order to prove a point? Because the net effect of that is hundreds of thousands, if not millions of Chinese will be laid off. Not immediately, but 6 months later, 9 months later, 2 years later. And if you got millions of people, you get another Tiananmen Square. So by all means, if you want to make stupid decisions, be our guest, but there are consequences of that, and that is you will leave yourself in obscurity and you'll become the next Japan. And I don't think, I think there's too much intelligence in Beijing, and certainly academics that have studied enough history to know that it would just be suicide to ban delistings. Now, what the languaging has been, which is why we've had this bounce off of that acute bottom last week, is smarter communication. Number one, this was the big thing that the government did, was they approved a deal, Tencent to do with Sogu. After they said they'd have to approve all deals, they approved one. So first they declined one, and then they approved a different one, and that's when the whole market inflected. So they went into Didi's offices. Maybe on Monday, Didi's still operating, and then it's off to the races. You know, these are the type of baby steps that you need to take. And I think they sent a crystal clear message. If you're an IPO, you got to come answer to Beijing before you even talk to the SEC in Washington. And I think, you know, if you want to retain power, that's the thing to do. And, you know, that makes perfect sense. But I don't see them saying, let's blow up $2 trillion of free money that we've gotten from the West to fuel our innovation and our growth, particularly when we want to have our own semiconductors in the next 5 years and we're way behind. Bad idea, bad for their employment outlook. And I don't think they're going in that direction. I think the West is more scared of their next action because the Didi thing seemed so unpredictable. But if you look under the cover, it looked like Didi actually ignored a lot of warnings and kind of their timing wasn't brilliant. And so they had to pay the piper, and they're doing that in spades. But that, you know, to extrapolate that to $2 trillion of liquidity, now people say, well, institutions will then just get the Hong Kong listing. Sure, they can do that, but now we've got a warning on Hong Kong. So and by the way, Alibaba's not going private, so it's too big a check for anyone. So I think the smoke is starting to clear, and you know when you get started, you have those putters and you have those step backs. But it seems like that was the acute sweep last week. We'll see if that follows through. This was just some upgrades on Splunk, which is still up 30 points, which is good. That's working higher. The business trip, people are saying, when is the business coming back? Las Vegas trip is back mostly, and you can see that in the TSA numbers. We had 2.1 million people last year. This year versus 700,000 last year, 2.7 the year before. So the consumer is making up a lot of the lost business. I think that business is going to come back in the fall, and we'll be at record numbers, which is a good thing to see. And then you're saying, well, how can that be, Tom? The Delta variant. I mean, boy, the stuff that's coming. And it's right to be scared. There was a great article in the Wall Street Journal today from Leslie Bianin and Monica Gandhi, the reassuring data on the Delta variant. And they just basically walk through how the name of the game is hospitalizations. They're collapsing, whether the Delta variant's as potent or not. And it's only really popping up in those areas that don't have enough mRNA vaccines yet, which, they're slowly getting to aggressively. I think what you're going to see here, honestly, is I think you're going to see an approval of the vaccines from the FDA, and the last, basically 20% may never get it. The last 10% that hasn't gotten it, once it's approved, will get it. And then the Delta thing will go away, and then the mRNA for the rest of the world is the key thing. They'll get it. But Delta was found in March. Okay, so here are the two charts. This is cases per day and deaths per day. And, if I was to say this terrible variable kicked in March, let's see what happened. Well, I would say if that's a terrible terrible variable, can you please do it again? Because cases have collapsed from 56,000 a day to 22,000 a day. And since the CDC announced the variable in mid-March, deaths have collapsed from 1,100 a day down to 230 a day. So, if that's the variable, the deadly variable, and what's happened in the 4 months since it came on our shores, please do it again. And I'm being a little facetious here, and I'm not trying to diminish what could be certainly serious, but the name of the game is the mRNA vaccines seem to have it under control. And I think in that article they said it's like a 87% efficacy or somewhere in there. It's lower than for the original strain, but the effect is not, it's not like a serious illness. It can be asymptomatic, it can be very mild. So, I think that the final hurdle for vaccinations, as much as they have focused on other things, is just the FDA approval. Once it's finally approved, I think that marginal 10% that's going to make the difference for herd immunity will probably jump on the bandwagon, and the last 20% you'll just never get them no matter what you do. Unless you do more lotteries, maybe you'll get more people to sign up. This was the article. Weekly mortgage finances spiked 20% after interest rates dropped to February low. So again, we're more bullish than estimate, but we do acknowledge that, in a rising rate environment, they'll be less than last year. And that's what they're trading on, is that the growth will not replicate last year, and I think that's underestimated. So we've gone through that. This is the Fed balance sheet. That's the most important thing. Before you get bearish, you want to see this thing, before you get aggressively bearish, you want to see this thing go down. And if you want to get bearish on a secular basis, you need to see the yield curve invert. And we're nowhere near that. We just steepened, and now we're grinding sideways, but we're in the early days. So, hold on to your horses. If you get some bumps, add for the long term is our view. Okay, this is very interesting. Fund managers have now unwound their post-election vaccine bets survey finds. So the Bank of America Global Fund Manager Survey says that, they've gotten out of the reopening trade. They've jumped on tech. We were talking about tech 6-7 weeks ago. It's now run. And now they're out of that, which tells me that over the next few months, once you get everyone out of it that joined late, then the trade can start to work again. But I think we've got a little time to bide, and in that time where things are just choppy and uncertain, like people felt this week, that's when defenses are going to kick in, which we've been waiting for this second leg, and it's finally happening. So we're excited about that. But for all these people worried about, the key takeaways from this Global Fund Manager Survey were economic expectations have peaked, inflation expectations have peaked, and profit expectations have peaked. And people say, oh my God, that's terrible. Well, that happened in 2009 after they went straight up, and 2002 after they went straight up. Same thing with all of them, and that was the beginning of the business cycle. So these are good things. The positioning, everyone jammed into tech last month. They jammed out of emerging markets and consumer staples and energy. So particularly staples, I think this is where the opportunity is going to be. So at least for the next few months. And then we'll come back to that cyclical trade once they're fully out and they've totally puked them and said, oh, it's energy again. Why did I fall for the trap? And that's the trap. And that's when we top up for the long term. Most crowded trade now is tech. that was quick. And then biggest tail risk is inflation. So that was the Bank of America Global Fund Manager Survey. This shows you the article of the week, the whole lot of nothing stock market and sentiment results. This is the small caps have ground sideways. Maybe those executive orders will make an impact, probably not. But this is where you want to start to pay attention. Can this thing break out after consolidating? And I think in the back half of the year, we're going to find that the answer is yes. We know what this range is. Dow Jones has done nothing since in the last 2.5 months. You can see here, it feels like a lot's happened, but not much has happened. What has happened is tech and tech's been bid up in the last 6 weeks, and that's why the S&P and NASDAQ are up. And you can see the performance since they announced the vaccine on November 6th. Financials and energy were the top two performers, which you can go back to our notes here on hedgefundtips.com under commentary category or sentiment, and look back to our articles before the election. We're pounding the table on banks and energy, and these naturally have to take a break. And look what we're going at right now. What we're exposed to is the laggards, utilities, staples, and this is healthcare. Those are where we want to do, because guess what? Last year, this is what financials and energy looked like, although they were even more negative than this. So we're buying we lightened up on the leaders that we bought when they were laggards, and now we're buying the laggards, and we'll lighten up when they're leaders once again. It's just it's a game of musical chairs. That's basically it. Flavor of the month. We went through all these. This was a table on some of the dividend aristocrats. You can go through that on your own. Their yields, their multiples. You have some like Walgreens Boots Alliance still with a 3.8% yield. It's trading at just 9.3 times next year's earnings. And while it's up for the year, it's just announced same-day delivery, so it can compete with some of the threats. Same-day delivery for prescriptions. So that's a very positive thing that I think can give them an advantage. It's basically like all their stores now are becoming Amazon warehouses for prescription, and so they should be able to retain the moat there. And I think the other thing that they need to see, believe it or not, the pharma companies need to see people go back to their doctors for in-person treatment and for testing and physicals, so they could find out what else they're sick with and give them drugs. What the pharmacies need is they need people to take off their masks so they can get regular colds. People haven't had regular colds in a year because they've been at home with their masks on. Now that they're taking their masks off, they're getting colds, and they're going back to the pharmacies to pick up Hall's cough drops and Robitussin. When's the last time you bought a bottle of NyQuil or Dayquil? I mean, that stuff's all going to come back, and they're going to be flying next year as a result of it. Okay, so we covered the Bank of America Global Fund Managers. Sentiment started to come down a little bit. There's fear in the Fear and Greed Index, and National Association of Active Investment Managers. I think that moved marginally since we did this article. That would be 93.27. So there's a little exuberance. We'll see if they get flushed out. But the outlook for the week, we made no major changes to our outlook. Tech has continued to grind higher as we anticipated. We added to some pockets of value, which are referenced in the segments above. Think that basket of mortgage originators and some of the generic drug providers. And then we continue to like laggard defensive for the next couple of months. Utilities, staples, and pharma. We've had that exposure since last week of February, early March. And now they're taking their second leg higher. And we finally saw a nascent turn in Alibaba this week after adding materially on last Thursday's weakness, which we referenced in the podcast. We'll go into further detail on, okay, that's today, Friday. We also saw a lot of interesting, unusual activity in Discovery, in Boeing, and in Las Vegas Sands. This was a huge block, 17,000 contracts, as well as Alibaba. Was just yesterday, 4,000 contracts for the January 275. That's a big move. If we hit 275 by January, we're going to Sizzler. I'll tell you that right now. But it wouldn't be out of the question, because when sentiment turns and people realize what they left on the table, it's the same thing that happened with energy. It's the same thing that happened with banks. It just happens over and over because human nature never changes. Some economic data for the week. Let's take a look. CPI ran a little hot. We expected that. We knew that. The core CPI, same thing. We had a modest... Where's the EIA? Distillates, crude imports, inventories. We had a big draw in inventories, negative 7.8 million. So, yeah, that's good. And then continuing jobless claims was positive. It ticked down a little bit from 3.3 to 3.2. Initial jobless claims was as estimated, 360,000. Retail sales were very good today. Core retail sales were good, so the consumer's strong. And then there's another stimulus, by the way, that they're sending out this month that they've been spending a lot of time on. I think it's $300 for kids or something like that, but it's a big basket. 80 or 90% of the country is going to start getting these checks in their mailbox in the month of July, and no one's really been focused on that. So, with the Fed balance sheet and that kind of additional stimulus, it's hard to get too aggressively bearish. Yeah, you could get the black swans, but if you bet on those, you'll be in the business for 5 minutes, because you lose more money doing that. And especially doing it this early in a new business cycle is very risky. And we saw that with the skew. It burned through a huge amount of premium over the last 2 months. Look at all of the catastrophe insurance that was bought. We went through earnings. We don't have to do that. But, we've covered the skew a lot. Let me just show you how much catastrophe insurance got burned through that didn't come to pay out. So people buying, two standard deviation out of the market. It peaked in June. They were just buying left and right. A lot of this got burned off at June and July expiration. Didn't pay out. So, it's worth keeping an eye on. We've spent a lot of time on skew in past VideoCasts, so we won't spend time here. And then finally is the earnings. So 69, the growth rate is already 69.3. Estimates were 63. We said they're going to be greater than 70. We'll see if that happens. 85% of companies beat. That's bigger than the historical average. 90% beat on top line, 85 on bottom line. And they took estimates up again, although modestly for 20. I'm most interested in 2022. Went to 213.62, so a couple pennies. And for this year, 192.95. So we got to see over the next 4 weeks, does this thing start to approach 220? And if so, then we're in a fully valued. If this flatlines, then some of the high flyers have to come off. We'll keep a closer eye on that, but they're still headed in the right direction, and that's been our basic thesis. And if you look relative to pre-pandemic, $163 in earnings in 2019, $213 estimated for next year. It could be $220. That is a huge jump. So things are moving in the right direction. Want to thank everyone for listening in. I know it's summer. People have plans. So until next week, thanks for listening in. Make it a great one. Bye for now.